Hello, everybody, and welcome to the August webinar for Solder Brothers Emerging Companies Limited SB2. We've just got a couple of people getting uh, let into the presentation, so we'll start in approximately 30 seconds' time. Thank you for your patience. Okay, look, I think we'll make a start. We have a quorum there, and as always, there'll be a recording available of the presentation where any latecomers can join from there. But hello again and welcome. Again, my name is Greg Taylor, Head of Equities at Solder Brothers, and here today to provide the monthly webinar on Solder Brothers Emerging Companies Limited, the listed investment company under the ASX code of SB2. Um, Great to be presenting today and excited to be able to have a couple of the key members of the team presenting alongside me today. So, uh, as always, I'll give a bit of a snapshot of SB2 and the recent performance, and then what we thought would be quite topical and helpful today is just to talk through a couple of the key holdings in the portfolio that have either just recently or scheduled to in the next week or two release some updated financial information. So I thought it would be a timely opportunity just to review the thesis for the holding and a couple of things we're keeping an eye on for these particular names in the portfolio. But as always, there is Q&A available in the chat function there. Though if you didn't want to ask a question here online, the contact details of myself are also made available at the back of this presentation, and please feel free to reach out at any time. Okay, if we just jump over to the agenda for today, what we'll see is that uh, I think there might be, there we go. Yeah, so again, we'll talk a little bit about the recent research rating that was undertaken on SB2. Then they said we'll dive into a few live stock examples and then talk a little bit about relative market valuations, a bit more of a deeper dive into recent performance and portfolio positioning, and then just a few of the ongoing endeavours to close the discount to the NTA. But if we jump over to the executive summary, just to rebase everyone to the same level. Again, Solder Brothers, global investment manager with now over $4 billion of assets under management. The Solder Brothers Emerging Companies Limited product, SB2 is the ASX code, is a managed listed investment company. It's important to highlight that the mandate for this fund is dedicated to investing in small cap Australian companies with a market capitalisation of under 500 million, so a genuine small slash micro cap product. Pleased to report the fund has over a 4-year track record now and has consistently outperformed the small cap market over that period, and in particular over the last 3 years. What was particularly pleasing was during the month of July, which was the last NTA struck for the fund. The fund achieved just over a 7% positive gain for the month, which is quite strong performance and significantly outperformed the market. And it was particularly pleasing because I think I spoke in last month's webinar around the dynamic of not a lot of news flow and a few stocks in the portfolio. Share prices had drifted lower purely off the back of any new data points or information released to the market. We always look forward to key months of July and August because they're when a lot of data points come out and really strong validation for or otherwise for key investment holdings and the thesis driving them. So again, really happy with the team and the portfolio during the month, and that's continued again into the month of August, which is encouraging. As a result of that strong performance, the underlying share price hasn't really moved of SB2, still trading around that low 70-cent range, and so that's taken the discount out to 35% to the underlying post-tax NTA of the fund, and we'll talk a little bit more about that and what we're doing to close that discount later on in the presentation. But if I jump over the slide, one key development, which is part of raising the awareness of SB2 as an investment proposition and generating more demand with the objective to lowering the discount to that NTA, was to have an independent review undertaken on the fund, and that is an independent research house that comes in and does detailed due diligence of the investment team, the process, the investment manager themselves, performance, and a lot of other quantitative and qualitative factors. This review was taken by SQM, and very pleased to report we received a strong 4 out of 5 star rating for the product, which we were very pleased about. And a copy of that report is made available to wholesale investors. So if you'd like a copy, please do reach out, either contact us via the website or via the contact details at the back of this presentation. But again, really strong validation and independent one at that for the team and the process and what we're been doing for over 3 years now with this product. So what we're going to do is a little bit different from the normal webinar today. We're going to jump into a couple of case studies of key investment holdings within the portfolio. But I'm really excited to have a number of the key senior analysts within the team presenting these. So what we'll start with is Dane Grant. He's going to talk us through the investment case for a recent position that we've been building. It's been very successful to date, called Worker. WRK is the code. Dane's a key member of the team, been with the team for over 2 years now. Joined initially as an intern and has added significant value during that time, and was the key analyst behind this investment recommendation. And I'll hand over to Dane to share his views.
Thanks, Greg. The fund has been an investor in Worker for almost a year now, but the company's just recently won some meaningful contracts, significantly increasing our conviction in the holding. But before I get to that, I might just talk through a little bit of what they do. So Worker is a regulatory compliance technology company specializing in superannuation payments. Their technology is basically what processes the payment of super and all the information surrounding a payment of super. So from onboarding KYC information, bank account details, tax file numbers, to employees actually choosing their specific fund, and then to processing the super payments, much of which is still paper-based and inefficient for a lot of super funds. And it's a key issue that's looking to be rectified with the payday super regulation. And just quickly on payday super, for those who don't know, this is a proposed change in regulation to be ratified on July 2026, which very much supports Workers' growth ambitions, with key changes to require employers to pay employees at the same time as their wage or salary, and requires super funds to hold more information on employees, and will bring bigger fines for failure to make payments on time. And the key impact we see from this is a tailwind encouraging super funds to implement new software like Workers, and also a likely increase to ARPU and the revenue the Worker will make off their existing customers and customers that they do sign. I think it's worth talking through. There's been a fair few significant announcements from Worker, which has increased our conviction and also their share price of late. Firstly, Worker signed a key partnership with MUFG, who is a manager for or has several major super fund clients, including Australian Super, Rest Super, Host Super, and a handful of other funds. Initially, this partnership included just a pilot trial with Rest Super, trialing the software with a small number of users and collaborating with Worker to build additional features into their platform. This pilot concluded in June, and Rest is now looking to start onboarding their users at the end of this calendar year. So that's a significant win for Worker and the key new super fund signing. The company also announced in July that Australian Super, the largest MUFG client, has also chosen Worker's product. And this was really significant as Australian Super is the largest super fund in Australia, and they conducted a year-long competitive tender, eventually choosing Worker, which we see as a really great validation of their product. Also, 2 weeks ago, Worker completed a $15 million raise. This was to provide capital should any further funds or payroll providers beyond Australian Super and Rest Super sign with them, so that the company can push to implement those potentially further funds before Payday Super in July 2026. This raise also provided capital to aggressively chase the circa sort of 250,000 SME customers of the ATO clearinghouse, which will be shutting down on July 2026 also. And there was also capital raised to support integration of potential bolt-on acquisitions. And this is the key strategy for the company's continued growth. Once they get as many users on their platform as possible, ideally close to their 7 million target, they'll look to capture additional compliance moments and sell directly into those onboarded users. So there's quite a bit happening in this company, but we have quite high conviction. And it's sort of our current view that of the contracts this company has won already, that there's still upside to the current valuation, but with good execution and a couple additional signings, that this could sort of be worth upwards of 30 cents or more. So yeah, it's a pretty exciting opportunity. I might also just talk through our fabs if that's all right.
Yeah, thanks, Dane. Yeah, we'll jump over to the next slide. But yeah, work has been a key position, which I think is really reflective of our process. That we built a position, started a position, so just on 12 months ago, and continued our monitoring and diligence. And once they hit key milestones, we look to build into that position. And Dane's been pretty modest there. It was fortunate enough to start that share price journey sort of below 3 cents a share and up over 10 cents a share as we speak today. So it's been a good one, but we recently challenged ourselves around should we be holding this or potentially selling some, but there is really strong conviction that there's significant upside remaining, more than 100% upside in our view. So we've continued to hold it as a key holding, and look forward to providing updates over the next 12 months. But sorry, Dane, back to you in relation to our fabs.
Yeah, no, all good. Thank you, Greg. So I'm not sure, some of you may be familiar with our fabs. It's been a fairly key holding in the portfolio for over a year now, and has done quite well for us also. But we initially invested in the pre-IPO round for our fabs at the start of calendar year 2024 at sort of 18.75 cents, and then further built to the position during their IPO in June 2024 at 25 cents, and then mostly held that position since. So there's sort of two key parts to our fab's business. Firstly is their initial engineering arm, which specializes in off-site fabrication work. This is a really good business with a strong, reliable reputation, taking subcontractor roles in large, often government projects. And they've built and won awards for the Northern Concourse roof at Sydney Central Station, which some of you may have seen. And they've also been involved in the refurbishment of Parramatta Light Rail, and they have many more other projects. The business has performed well, delivering 3.6 million EBITDA in the first half of 2025, up from 2.2 million in the prior period. And that's mostly just driven by good team leaders and strict project selection. But while we invested in our fabs, and where a lot more of their substantial growth has and is coming from, is their fairly new mining hire segment. the company won some big contracts, including Malabar Mine, where they've now delivered all the equipment, and we'll start to see some influence from those contracts coming into their financials, hopefully in the coming week. And we really like this business because they hold a fairly significant competitive edge where they can lean on the skills and capacity in their engineering business to build and maintain equipment significantly below market rates. And that's been their key strategy of buying up very old used equipment for cheap, refurbishing it in-house to a new state, and then hiring it out as if it's new equipment. So instead of sort of buying a piece of equipment for $12 million, they can roughly build it for $7 million and then hire it out at the same rate as a company who bought that equipment for $12 million, allowing them to achieve really attractive returns on capital. There's also been some strong tailwinds for our fabs, with a significant competitor having corporate and operational issues, and a lot of coal mines looking to minimize their own capex, which both should support inbound demand for the foreseeable future, or that's how we sort of feel. Our Fabs is, in addition to this, our Fabs also has opened a new protective coatings warehouse. So they've expanded their existing capacity, which should see some additional growth in that segment. And they've also have a product called bat bags, which is experiencing a strong tailwind also with a regulation change where in New South Wales required the required quota per square meter has halved, so it's essentially doubled the market, and our Fabs is a market leader there. There's actually only really one competitor in that market, and our Fabs actually manufactures the product for them, so they're in a very strong position to capitalize on that. And then another key attraction to us for our Fabs, which we've sort of spoken about a couple of times, is they do pay a strong, fully franked dividend. With the management's goal to pay out 50 to 75% of NPAT each year. And in the first half, they paid 75% of NPAT, which was 1.5 cent dividend per share. And we expect the dividend to likely be sort of between 1.5 or 2 cents in the second half, which is great, which is a strong dividend yield. Yeah, well above sort of around 8% annualized. But yeah, that's sort of mostly it on our Fabs. It's still a high conviction position in the portfolio, and I think it is our largest holding at the moment. So been quite happy with it so far.
Yeah, thanks again, Dane. I know there was a question there in the chat around the stated PE multiple for our Fabs as a on the FY25 figures. I think the question was just saying that the market cap seems high, is now at 125 million, and the consensus, which is the broker consensus NPAT, is at 13 million. So the question was, are we assuming a materially higher level of profit than consensus? I think it's two factors at play here, and thanks for the question. One is that the multiple was struck. It has had quite a strong share price run over the last month, and so the market cap was probably closer to below 100 million at the time of putting together this presentation and this document. And secondly, yes, we do believe we're a little bit higher than consensus on the NPAT. So it's a combination of those two factors, and I think our observation of the share price got back down to the low 30 cent range only a month or two back, and now it's trading up to the mid 40s ahead of the result. So I think typically that's a pretty common sign that the market is expecting a strong result, and so that result's due out next Monday. So time will tell, but yeah, we're pretty confident in our thesis on that one, and we do think the market's numbers are a little bit underdone. And I think there might be some pretty significant upgrades forced to come through with that broker consensus over the course of the result release in the next week. But thank you again for the question, and thanks, Dane, for that. I said our Fabs again. It's been a good one. It's one we took an investment position pre-IPO. We're the only institution that took a pre-IPO position, and we've held that throughout. It's probably doubled since that time in valuation, but we still think it offers compelling upside, and we think the catalyst is coming literally in the next couple of weeks. So look forward to that in the next couple of weeks. Thanks again, Dane. Now I'll hand over to Frankie to talk through another one of our key positions, and it looks like a little bit like the comment I made just earlier about the stated PE multiples and the current share price and multiples market cap that was put in this presentation. It is dated a couple of weeks, and 2 to 3 weeks, just in preparation of this document ahead of time. And in each case of these companies have all actually had pretty strong share price performance over the last week or two, which definitely is just a coincidence. And EROAD definitely falls within that category. It's one that's had quite strong share price performance, and Frankie will talk to that now, and what drove that uptick. But in this instance, we did trim a few shares over the last week or so just to rebalance the holding, but absolutely remains a core top 10 holding in the fund, and will continue to provide some significant upside going forward. But just as I hand over to Frankie, Frankie's been with the team coming on 3.5 years now, and been a really valued contributor throughout that time, and a big contributor to the fund's performance as well over the last 3 years. But EROAD was one of Frankie's stocks that he pushed. Did a lot of work, including some international travel to shore up the investment thesis on this one, and we've been handsomely rewarded. So over to you, Frankie.
Thanks, Greg, and hi everyone. Just as Greg's mentioned, we'll speak over the investment case for EROAD. So EROAD's an international hardware-enabled SaaS provider delivering safety, compliance, sustainability, and efficiency solutions. Its connected platform links drivers, vehicles, assets, and operations, giving commercial and government operators across New Zealand, Australia, and North America real-time visibility and control. EROAD continues to benefit from a land and expand model where initial customer wins, often based on the core telematics or compliance needs, then can be scaled meaningfully through the adoption of additional modules. And Soul Brothers first started our position in July of 2024 and have accumulated the holding ahead of the March year-end results in FY25. And the subsequent share price appreciation elevated EROAD into a top 5 holding within the fund. And as Greg just mentioned, we've taken the opportunity to reposition the holding. EROAD solutions are embedded in demanding, highly regulated fleet operations, including food distribution, construction materials, and heavy transport, enabling customers to operate smarter, safer, and more sustainably. The company pioneered the world's first GPS-based road user charging system in New Zealand, and in North America, EROAD is gaining traction with a growing pipeline of enterprise opportunities supported by platform enhancements and rising market awareness, positioning them for the larger addressable market in North America. In May 2025, EROAD delivered a strong full-year result, significantly exceeding market expectations. Free cash flow rose to 16.1 million New Zealand dollars, despite a 7.5 million New Zealand dollar capex drag for the temporary impact of the 4G program, which is expected to conclude this calendar year. The company also issued FY26 guidance for the revenue of at least 205 million New Zealand dollars and a normalised free cash flow yield of 8 to 10%, and a medium-term ARR growth CAGR of 11 to 13%. To date, billing in New Zealand has largely followed a monthly collection model, and management has flagged the potential to transition to annual upfront payments, which was successfully introduced in the North American market in FY25. The shift would materially accelerate the free cash flow conversion across the business. Recently, the New Zealand Transport Minister, Chris Bishop, unveiled the government's plan to transition all New Zealand vehicles to electronic road user charging, or ERUC. EROAD is established already as a market leader in the current road user charging system and is well positioned to capture an additional 3.5 million vehicles under the ERUC system, representing a significant growth opportunity. As fuel tax dollars decline due to increasing fuel efficiency and EV adoption, the New Zealand government is looking for a fairer way to tax road usage, hence the shift to an ERUC framework. The exact product revenue model and where EROAD will sit in the ecosystem remains unknown. However, we believe the domestic transition to ERUC represents a genuine opportunity to generate over $100 million in revenue. With improving profitability, robust free cash flow, and a strong growth pipeline across its key geographies, EROAD presents an attractive combination of operating leverage and recurring revenue growth potential. This covers our investment case for EROAD. I'll hand it back to Greg to discuss the further points on the fund and the US dislocation between small cap and large cap valuations. So, thanks.
Thanks, Frankie. Yeah. Again, just to put that into context, we were a little bit of an early mover, which is often the case with what we do, because we do a lot of diligence, and we tend to weigh into a position a lot earlier than most other institutional investors, and we were rewarded for that with EROAD. The average price we built our position was below $1 a share, and as of today, the share price is up over $2.10 per share. So again, there's some commentators out there talking to significant further upside, and we do agree that there is upside potential, but again, we prudently trimmed a little bit in the last week just to keep the portfolio positioning at appropriate levels from a risk versus reward perspective. Okay, just jumping over the slide, I feel like a bit of a broken record, but I'm going to continue to pull out these data points on why small caps are once in a sort of decade or 2-decade cyclical low in valuations versus large caps. So the latest chart that we're sharing here, which came from Bloomberg, shows the price to book valuations in the US of the Russell 1000 versus the Russell 2000. So it's effectively their large cap and small cap indices for that US market. And as you see, it's up to about 3 times higher for the large caps than small caps. And as you can see, over the last 20 years, it's been as low as almost par. And you might be able to justify through time closer to a 0.5 premium. But to be 3 times premium just shows is yet another data point on why the investment case for having exposure to small caps versus large caps is as strong as it's ever been. And we had difficulty sourcing the exact like-for-like numbers here in the Australian market, but again, the fundamental valuation measures of small cap versus large cap in Australia market still sees greater than a 20% differential, which is at 20-year highs. So all things are pointing towards a bit of a reversion to norm and the longer term averages, which plays into the business case or investment case for small cap exposure. And really believe the ongoing interest rate reductions that we're seeing globally is likely to be a key catalyst for the closing of this gap. And we've seen that even over the last month or so, where small caps have started to outperform relative to large caps, but there's, in our view, a real long way to go. Investors really should be thinking about their exposure to small caps. Jumping over the slide now, what we see is just a bit more detail around that performance. We spoke about that very strong 1-month performance. It was a bit of a kickback after a weaker performance over the last 3 to 4 months, and a lot of that was due to sort of differences between the industrials and resource performance within the index, where resources were outperforming over that sort of 3 months to June period. With our fund not having any exposure to that, we even though we don't manage the portfolio relative to a benchmark, we need to provide some sort of reference point for investors to measure us, and that we think the most appropriate is the ASX Emerging Companies Index, and due to its increasing weight in resource companies, it shows performance there. But what you can see over time is that the fund has continued to deliver positive performance. Then over the longer 3-year plus periods, outperform the market quite comfortably. Then we normally, as we jump over the slide, we talk about just the relative positioning of the portfolio, and starting with the top 5 positions. 2 of those which we spoke to today in Alfabs and E-Road, but off the back of increasing our dollar cash investment in the worker position, as well as very strong share price performance, that's now, as at today, a top 5 holding in the portfolio. So, and then these metrics I continue to reference, which is almost a bottom-up view of, or absolutely a bottom-up view of, why there's a really strong investment case for exposure to small caps. Is the ability to, these metrics are the weighted average metrics of the entire portfolio, and been pretty unique times, and I've been saying for 2 years now, but you can invest in a portfolio where the revenue grows up near 20%, profitable companies trading on single-digit earnings multiples. Doesn't happen very often through a 10-year cycle, and we're in that part of the cycle now. And so we continue to believe that the outlook is positive and justifying a good exposure to small caps. And then just jumping over the slide here, we talk about the discount, and I said it has gone out to 35%. That's not because the share price has gone backwards. It's because the underlying performance has been so strong without much movement in the share price. A couple of other things at play here, and we're trying to close that discount. First one's the ongoing commitment to the on-market share buyback. We actually can't operate the share buyback until the full year financial results for SB2 are released later this month. So for this month, we've been in a blackout period, so that we haven't been activating the share buyback, but absolutely the intention is, post the release of that result, which we don't expect any surprises in, that we will reinitiate the buyback. Also, what we'll be announcing with the result is the full year dividend. We announced a fully franked interim dividend after the half year result, and the expectation is that we'll continue to pay a dividend, and a fully franked dividend, and the exact level of that dividend will be confirmed later this month as well. Another point really worth noting is there has been a real rotation of the share register. We had a number of Visa-linked investors into the fund, which was greater than 50% at one stage of the share register. They've been transitioning out. We've been replacing them with longer-term fundamental investors, and so that overhang of legacy shareholders is now down closer to 10%, which means that selling is definitely drying up, and now we're continuing to work on creating new buying interest to drive the share price closer to the post-tax NTA value of the business. 2 other important things is, again, that commissioning of the SQM independent research report, which I mentioned at the start of this presentation, was done to raise awareness and raise the addressable market for wealth managers and advisors that can recommend the SB2 fund to their clients. So that will be a positive catalyst in generating, hopefully, buying demand. And the other one I've touched on, which I think timely to give a bit of an update on, is there are a small number of unlisted or private holdings in the portfolio. I spoke at the start of the year about the likelihood that these unlisted holdings will head towards an exit, and that could be quite a positive catalyst for the performance of the fund. So there was 2 in particular that I called out. I can confirm that my confidence in the likelihood of them transacting and getting a positive outcome significantly higher than their current carrying values in the fund remains. They're both in a process, which means that an advisor's been appointed, and there are various counterparties submitting bids for those respective businesses. So, uh, you know, there's no certainties, and I can't guarantee that there'll be an outcome on one or both of those investments this calendar year, though the probability is only higher than it was earlier this year, and that process will continue. And as soon as we have any information we can update the market on, we will be sure to do that. But put in perspective, that could have a material impact on the underlying asset value of the fund and hence the fund performance if those private holdings were exited at the significant premium to the current holding value they are positioned in the fund with. So we'll keep you updated on that. But combination of all those factors and ongoing marketing initiatives such as this webinar, such as conference presentations and national roadshows will continue. And hopefully with a bit more positive sentiment towards the small cap sector and more eyes on the small cap market, we can drive that closing to the discount and get that share price up closer to $1 a share. Okay, I think that's all for now. Beyond that initial question, I don't believe there's any others. But Megan, I'll just pause to see, are there any other questions that have come through?
No, I can't see any, Greg. So
Okay.
Good.
All right, excellent. Well, thank you everyone again. Again, thank you to Dane, Grant, and Francis Croswell for presenting. Again, thanks again to those guys for their meaningful contribution to the fund and the fund's performance, and hope to provide further exposure to investors to the key team members as we continue these forums. So close out with a thank you. Any further questions, please reach out, and we look forward to providing further update following the end of the reporting season in August, and that next webinar will be in mid-September. Thank you again. Goodbye.